The best way to visualize the difference. It takes all the theory we just discussed and puts it into a real-world dilemma. Let's set the stage carefully.
Okay. A company needs money for a new project. Let's say they want to build a new plant.
We need cash.
And we have two numbers. The current market price of the stock is 70. That's what it's trading for right now on the exchange.
70, got it.
But the calculated fair value, the intrinsic value based on all our models and forecasts, is 80.
Price is 70, value is 80. Keep those numbers in mind.
Let's go through the three perspectives.
Yeah.
Perspective one, the CMA, the manager.
Okay, I'm the CMA. I look at this and I say, the market price is 70. My intrinsic value, what I know this company is worth, is 80. The market is undervaluing us.
Okay, so that's good, right? Being undervalued usually sounds like an opportunity.
For an investor, maybe. But for the manager who wants to raise money by selling shares, it's terrible.
Why? Walk me through that.
Because if we issue shares now, we are selling them for 70 when they are worth 80.
We're getting a bad deal.
You're selling $1 for 70 cents. We are selling them too cheap. We are causing dilution to our existing shareholders.
Explain dilution a bit more.
It means each existing share now represents a smaller piece of the pie, and we sold that new piece for less than it was actually worth. So the cost of equity is effectively too high relative to the price. We are destroying value for current owners by bringing in new owners at a bargain basement price.
So the CMA says.
The CMA says, do not issue stock. It's a bad deal for the existing owners. Stop the presses.
So what are the options?
Look for debt instead. Look for retained earnings. Or maybe delay the project. The focus is on protecting the company's value from dilution.
Wow. Okay, so the CMA sees the gap and says stop. Now perspective two, the CFA, the investor.
The CFA looks at the exact same numbers. Price 70, value 80.
And they see.
A bargain, a fire sale. The stock is trading at 70, but it's worth 80. That is a discount. It represents a margin of safety.
So the CFA says.
BUY, this is an investment opportunity. The stock is undervalued. The focus is on capital appreciation. I can buy this for 70 and eventually the market will realize it's worth 80.
The mismatch is where the profit lives.
Exactly.
It is hilarious that the CMA and the CFA look at the same undervalued status and reach opposite conclusions.
That's incredible, isn't it?
CMA says don't sell. CFA says do buy.
That is the beauty of the market. The manager wants the price high to sell equity. The investor wants the price low to buy equity. They are in a constant dance, a tug of war.
Now, let's bring in our third friend, perspective three, the ACCA, the executor or structurer.
The ACCA, the pragmatist, the one who has to make it happen.
Where does the ACCA fit in this drama?
The ACCA comes in usually after the decision is made or helps facilitate the execution of that decision.
Okay.
Let's hypothetically say the company ignored the CMA, or maybe they had no choice, they really needed cash, and decided to go ahead with some kind of funding.
The ACCA asks, how?
Exactly. The focus is on execution and structuring. The ACCA asks, do we do a rights issue or a public issue? What is the appropriate discount to ensure the shares actually sell? Is the timing right for the market to absorb this?
The nuts and bolts of the deal.
And the accounting treatment, of course.
Well, of course.
How does this impact earnings per share, EPS? How does this affect our gearing ratios? Are we compliant with IFRS? Is there goodwill involved? How do we record the transaction fees?
So the ACCA is the one making sure the deal is done legally, ethically, and recorded correctly. They are the ones laying the pipes.
The CMA asks, does this serve the goal? The CFA asks, is this a good bet? The ACCA asks, how do we implement and report this?
That is such a clear distinction. I feel like I finally understand why these different certifications exist. They aren't redundancies. They are different